Today, I want to talk about the psychological and economic aspects of stock market investing. I recently made a video with Francisco, Portuguese monkey with Russian accent. Surprised I said that so well. I'm getting over a cold. But I basically use this monkey to pick random S&P 500 stocks to compete against my own personal portfolio, just to see if I am better than a monkey. And it reminds me of when I got into stock market investing, because we all kind of start as these dumb monkeys. We all start chasing greed. And I still today go through this weird cycle, even with my current positions, but I become more attuned to it. And I think it's something we all experience as investors. Now, if you guys want to see how my portfolio pits against the monkey, I'll leave the link to that video in the description below, but consider subscribing as I will be updating that in 2020. But I look so forward to breaking all of this down for you. So let's just jump right in. Welcome back, my passive income investors alike. So I want to talk about the quick cycle that most of us experience as stock market investors. If you are new to investing, the reason you probably found this so attractive in the first place was because people were hyping you in to the lust of greed. We're talking those day traders, those really volatile sectors in the market like Bitcoin, the MJ sector. I mean, the list goes on. And we always hear about the stories of these people making all kinds of money, buying nice cars, doing all this incredible stuff. But for some reason, most people, literally 98% of people on the other end of the stick you don't hear about, are the ones that are losing money. And this is a cycle that I have experienced nonstop with all of my investments. And I usually go through this idea of greed where I'm looking for those really high yielding companies, whether it's going to be equity or dividend based. And then I move into the cycle of fear. Like, what am I going to be risking getting into this company? And then logic usually is what backs me up. Now, there's a few different ways people go through this, because the logic is what mitigates the greed and the fear. Knowing something that other people don't, that gives me a bit of reliance and grounding in my investments. So if I experience some form of volatility, I know based on the fundamentals of the company, well, I'm going to be fine. Now, most investors go through this cycle a lot differently if they do not know how to properly invest. And they start off with that greed and that lust of their friends, filling their ears with all those gambling aspects of, look at all the money I make, look at all the cars I'm driving because of Bitcoin, because of the MJ sector. And they go ahead and they jump in. But usually by this point, when everybody and their grandmother and their taxi driver is talking about it, it's a little bit late to the game. And then one of two things will happen past here, because fear always kicks in sooner or later, but the fear aspect of investing becomes one of two things. Either you actually make money and you're so scared of the money you have, it's not a long-term investment like your job, so you end up bailing on it, hopefully collecting some profits. But unfortunately, that isn't how 98% of people experienced Bitcoin. Now, I know I'm hammering Bitcoin a lot, but the MJ sector right now really resembles this, as a lot of people are holding on to bags of sand that they're hoping in the next 5 to 10 years are going to pay off on a gamble, because they don't understand the logic behind what they're doing. But this fear aspect usually becomes these one of two ways. Either you get scared, you jump out, or you freeze. And when you freeze, bad things happen. And I have watched this time and time again, where I'm sure you've seen when Bitcoin and Ethereum were going through these crazy high cycles, a lot of people just couldn't let go and they froze up because they couldn't understand a get in and a get out price. If you are going in to day trading or any other kind of trading where you're not really understanding anything other than the volatility of that individual investment, I mean, you are setting yourself up usually for failure. There are very few people that are capable of getting in and out of sectors. I like long-term investments that have a lot of logic behind them. Now, with some of my own personal companies I have made investments in, I continually go through this cycle, because I always start off by picking a base fundamentals of what I want, which is higher growth. I do not want market average returns. I would rather get somewhere between a 15 and a 20% return from the market, which to most people sounds like a big challenge, as most hedge funds can't even achieve that. But I'm going to tell you right now how, if you can take control of this cycle, well, you're going to be able to decently outperform the markets, as I have consistently over the last 5 years. Now, the first thing we have to look at, guys, is you have to get all into something. And the only way to do that usually is by putting your toe in the water. Your toe wet, guys. You're going to dump in maybe like $500, $1,000 starting, because what this is going to do is, after you follow those subset of rules to lead you to this stock, now you're going to do the deep diving. And the only way anybody ever really cares is if they have some skin in the game. So once you've kind of gone through your subset of rules, you got a little bit of skin in the game, now comes the learning curve, because this is where you're going to be paying attention to earnings calls. This is where you're going to be paying attention to the news and how the news is driving the stock versus the earnings and cash flow it is experiencing. And this is where you're going to get your your hands really deep down into this. And I know this might sound very extensive, but I promise you, once you've gone through this cycle, you're going to get comfortable, and sooner or later you can just forget about these companies because you're going to understand them well enough, and you're only going to have to check up on them periodically, maybe like once a year, if that. There's companies that I own like Northland Power that I had my hands so deep into in the beginning because it was one of the first stocks I ever purchased. I still hold that stock today, and I haven't checked out any real reports on it except for the odd balance sheet check once a year at most. But once you get your feet in, guys, you're going to learn so much about the company, and you're going to see how the news reflects the company, what everybody thinks about it, and how it's all going to reflect into the valuation of it. And then this is going to drive the logic, because once this logic kicks in, guys, there's nothing really holding you back, because you could be in companies like I'm holding, like a lot of the sin stocks, where there's a lot of negative news, but the negative news isn't affecting the bottom line, which is that cash flow, which usually derives what we call value stocks. And value stocks come from the idea that it's severely discounted against what it used to be, against the market averages. And it usually becomes discounted because of some form of bad news. For instance, with something like an MO, you're talking about the Juul news and all the afflictions going on with the, I'm sure you've heard about the news around Juul, right? I mean, that kind of negativity really drives down a stock price and what the public thinks of the company. But at the same time, go into the books and you're going to see nothing's really changed. And in fact, their revenues are actually increasing over time still. And when we can get to this understanding, everything gets a lot easier, because then all of a sudden, if the stock drops, say another 10, 20% from where you bought it, it's only going to be a buying opportunity because you just dipped your foot in, and now you understand the news, you understand the reflection on the stock price, and now that fear gets mitigated. And you are no longer scared of somebody coming up to you and telling you you are wrong, and it's going to leave you in a position to actually continue to further invest. And this is why we do what is called cost average investing, because this mitigates against any short-term risk and volatility. It's probably the most advised form of investing if you are buying individual stocks. You maybe want to drive it out over a year. For instance, I picked 3 stocks this year that I primarily focused on, and I literally spent the whole year cost averaging into them, to the point now where I am so satisfied with the position, I can set it, forget it, and collect income for the rest of my life. If you haven't figured it out, guys, the best way to invest is the long-term aspect. Like I said, greed is what drives people into the market, and the people that stick around are the people that think about what they're investing in. Now, I'm not saying for any reason that Bitcoin, the MJ sector, couldn't come back around and, be really fruitful in the future. But the problem is if you are investing in those companies and you have no idea what they are, how they work, and you're buying it presuming someone's going to pay you more in the future, you are called a gambler. You might as well go to a casino. What we do is we buy individual companies with the aspect of Warren Buffett style investing. You buy and hold for the rest of your life, and then what you can do is collect cash payouts, so that thing's going to turn over for you consistently, and it's literally going to put pocket in, or dividends as they call them, into your pocket every single month or quarter. And this is how we really nurse an investment. Now, the other side of this is the greed of seeing an investment go too high. For instance, if you look at Microsoft and Apple right now, a lot of people probably would be exiting these companies. And in my personal position, I think that would be a horrible idea, because you still have to go and buy another investment, and the chances of you finding a golden goose like Apple or Microsoft is very unlikely, considering those companies will probably be continually fruitful long into your lifetime and your children's lifetime. So we have to be very careful on both ends of the greed. Just because a company is up a lot and it's in your portfolio doesn't mean you should sell it. And then you're probably going to say, oh, well, the stock dropped and I didn't sell out. Well, it doesn't matter, because we're in this for the long game collecting it. In fact, Warren Buffett hasn't sold any of his shares in Apple, and he recently has been buying quite a bit of shares over cost averaging and over time. Now, even though I have been involved in the MJ sector and I've been very profitable in certain things, I took mitigated risks and I went into it with some logic, because I knew what was coming in the future. I mean, I was in the MJ sector before anybody cared. I was buying Canopy Growth Corp for like $3 a share. If you do not see something coming where you can understand the in and outs, don't waste your time. When I was buying Canopy, I knew what price I was paying and I knew what price I was getting out at. Most people don't have that game when they get into this. And now I'd love to know what you guys think about all of this in the comments section below, and consider slapping a like, because I am literally been coughing my lungs out all day. A terrible cold, guys. It's been going around. So I hope you guys enjoyed me making this extra video on my downtime here. So stay cool, stay awesome. I look forward to chatting to you real soon. Don't be a monkey.